Welcome to a new episode of the podcast. Vox Agent is made by AI for business executives that work with AI. Today, we're diving deep into the massive ripple effects of x.AI's recent $10 billion funding round, and really what it means for the entire generative AI investment landscape. It feels like a moment that could genuinely, redefine things.
That's absolutely right. The fundamental question we're grappling with here is whether this enormous investment serves as a kind of rising tide. Does it lift all the generative AI boats, bringing in more capital, more innovation across the board?
An alternative.
Or exactly, does it create more of a winner-takes-all scenario that, ultimately crowds out the smaller, aspiring players? And this isn't just theoretical, right? It's a critical strategic consideration for, well, every investor and business leader in this AI space. How capital flows, it really determines who survives.
Yeah, absolutely. And to help you navigate this, we've pulled together quite a stack of research, recent articles, some really in-depth analyses. We've got market data from places like PitchBook and Crunchbase, plus expert commentary. Our mission today is really to distill the most vital insights for you, kind of separate the signal from the noise so you can truly understand what's happening. So let's maybe frame this around that core hypothesis we often see in tech, right? The rising tide versus winner takes all. I mean, this isn't a new idea. We've seen it before in tech history. A company lands a huge funding round.
An extraordinarily large one.
Yeah, and it sends shockwaves. Sometimes it validates the market, sparks a gold rush, everyone benefits, but other times it kind of sucks the oxygen out of the room, doesn't it? Makes it really tough for others to get funding.
Precisely. And with x.AI's $10 billion, a mix of debt and equity, remember, both possibilities are, well, very much in play. The rising tide view is basically that x.AI's success, especially with Musk involved, acts as this huge signal of confidence. It says the market's validated its full potential. So that encourages more investors to pour money into other AI startups, hoping to find, the next x.AI. Think of it like a big halo effect. One company's win lifts the whole sector.
But surely a deal that big has risks too. Risks of distorting the market. What's the other side of that coin?
Oh, absolutely. That's the winner-takes-all assumption. It suggests x.AI's dominance, fueled by those incredibly deep pockets and, let's be honest, the star power.
Oh, the Musk factor.
It could paradoxically crowd out the smaller competitors.
Yeah.
Investor capital isn't limitless, right? So $10 billion going to one place might mean significantly less for everyone else, or at least it raises the bar much higher for getting a big investment. This view leans into a kind of zero-sum element. x.AI's mega round could set unrealistic valuation benchmarks, maybe siphon attention away, leading to what people are calling a funding squeeze.
A funding squeeze. That's a really interesting tension. Okay, let's unpack the rising tide argument first. What's the evidence pointing towards a broad surge?
Well, the strongest point is probably that validation and the halo effect you mentioned. That $10 billion isn't just about x.AI. It's a massive stamp of approval for the whole generative AI sector. Investors see a bet that big and think, okay, this really is the next frontier. We saw this already, didn't we? With OpenAI's ChatGPT success late 2022.
Right, and the Microsoft investment that followed.
Exactly. That directly triggered a funding frenzy in 2023. Global venture funding for generative AI nearly doubled from 2023 to 2024. It hit $56 billion.
$56 billion, wow.
Yeah, a 92% year-over-year jump. And we're hearing analysts confirm this trend isn't slowing. A PitchBook analyst just noted something like, we aren't seeing a slowdown. Big names like OpenAI, Anthropic, x.AI keep securing major raises. It suggests each big headline just reinforces that broader investor belief.
So it's not just the cash itself, it's the spotlight, attracting more general investment.
Precisely. x.AI's raise puts this huge spotlight on generative AI, and that helps everyone in the space. It reminds me a bit of Snowflake's IPO. That didn't just make Snowflake rich. It validated the whole cloud data platform sector. VCs started funding related startups much more readily, and the recent data backs this up. Over half of all global VC dollars in early 2025 reportedly went into AI startups. That feels like a broad shift.
And does that mean the overall investment pie is getting bigger, not just being sliced differently?
That's the argument, yeah. And Crunchbase data for Q1 2025 seems to support it. Global startup funding apparently rebounded to its highest quarterly total since 2022, largely because of these AI mega rounds. Overall, VT investment was up year over year, so it looks like new money is coming into the space.
Are there good historical parallels for this? A big event triggering a broad surge?
Oh, definitely. Think back to the dot-com era. Netflix IPO in '95, Amazon's early success. Those didn't just fund one company. They drew huge waves of investment into internet startups generally, fueling all that innovation. Or more recently, AWS and cloud computing in the 2010s. The rise of that foundational tech led to, what, dozens of unicorns being funded in related areas?
Right.
x.AI's $10 billion is, it's one of the largest private rounds ever. It builds on 2024's record funding for generative AI globally. What history often shows, though, isn't just a simple binary. It's often phased. An initial surge validates the market, followed by maybe a rapid consolidation phase driven by capital, compute needs, network effects. And given AI's intense compute demands, that consolidation could be faster, maybe more brutal than we've seen before, but the surge seems real right now.
It sounds like quite a few influential people are leaning towards optimism here.
They are. Many leaders see these huge investments as validation, not just competition. And there's that VC idea. Large exits create more startups. We're seeing alumni from places like OpenAI, DeepMind, Google Brain launching new ventures. They're clearly encouraged.
It's a fertile ground.
It really is. And maybe the most telling thing, the big players are hedging their bets. Look at Google and Amazon. They both poured billions into Anthropic, the direct competitor to x.AI and OpenAI after OpenAI started rising. That shows major investors are backing multiple horses. They're not putting all their chips on just one. But, there's a really compelling counterargument, too. Also backed by data, also backed by history. It suggests that x.AI's huge windfall could actually contribute to that funding squeeze for the smaller players. It leans much more towards a winner-takes-all outcome.
Okay, this is where it gets really interesting. Let's hear about this capital concentration.
Well, the data for, say, 2024, 2025 in generative AI funding, it's extremely top-heavy. Think about OpenAI's own $30 billion mega round early in 2025. Just one deal.
$40 billion, just staggering.
It accounted for over half of all U.S. venture funding in that quarter, and a third of all global VC funding. When one company pulls in that much, it just has to shrink the pool for others, doesn't it? Then in Q2 2025, reportedly over a third of all U.S. venture dollars went to just 5 companies. Presumably OpenAI, Anthropic, x.AI, the usual suspects. Axios put it really starkly. They said something like, "We simply didn't see multi-billion-dollar funding rounds during the dot-com boom. The bottom line, diversification is dying. Long live dominance."
That really speaks to this intense focus on just a few perceived leaders.
So it's not just the sheer amount of money, it's a shift in investor psychology, a belief that only a very few can win this.
Exactly. That's key to winner-take-all dynamics. VCs, especially in a hot area like AI, get convinced only a handful will reach the scale needed. And look, foundational model development, it's just incredibly capital-intensive. It has a high moat.
You need billions for the data centers, the talent, the best GPUs. Only players with that kind of money can really compete at the foundational level. It's almost like project finance investing, which makes it incredibly hard for smaller AI model startups to raise anywhere near enough. I saw analysis from May 2025 saying the funding environment for early-stage AI startups has actually gotten tougher. VCs are pulling back on seed deals. And another thing, x.AI's massive raise, with that speculated $80 to $120 billion valuation.
Yeah, those numbers are wild.
That sets this almost unrealistic benchmark. If x.AI is worth $100 billion, how does a smaller startup asking for, say, $1 billion look? Suddenly less attractive, maybe overvalued.
Yeah.
We saw this with Uber, right? They raised over $13 billion pre-IPO.
Yeah.
That let them outspend rivals, crush smaller competitors.
Created a vacuum.
Exactly. It created unrealistic expectations and a funding vacuum for new ride-sharing entrants.
Are we seeing hard evidence of this crowding out in AI already beyond the top-heavy funding numbers?
I think so. In Q4 2024, just 4 AI companies raised, $26.6 billion collectively. That was about a quarter of all global startup funding that quarter. 4 companies. And contrast that with early-stage AI funding, which hasn't exploded.
Yeah.
Q1 2025, global early-stage VC was slightly down. Seed funding fell 14% year over year. Pinnacle Digest had a good quote on this. Mega deals fuel innovation. However, this capital concentration can create market imbalances. A winner-take-all dynamic may stifle competition and make it tough for smaller startups to secure funding or talent. And history gives us more examples. Think about the SoftBank Vision Fund around 2017-2019. Yes, it poured huge money into select companies like WeWork, accelerating growth, but it also caused extreme valuation inflation, some huge flameouts.
Right, WeWork being the prime example.
And crucially, it made life really hard for startups not in their portfolio. Suddenly, they face competitors with seemingly unlimited cash. If x.AI and OpenAI have basically unlimited capital, they could do things like acqui-hire small firms at crazy prices that normal startups just can't match. Or think about Facebook. Once they hit dominance before the IPO, VC money for new general social networks just dried up.
So it sounds like caution is definitely warranted here, despite all the hype.
Absolutely. You hear figures like Emad Mustak from Stability AI controversially warning this could be the biggest bubble of all time, and Dan Primack at Axios summed it up perfectly. The bull case. AI's opportunity is so massive, everyone's piling in. The bear case. Incumbents and mega funds are playing offense, and diversification is dying. The bottom line, diversification is dying. Long live dominance. That really captures how a few huge players could dominate, making it super challenging for smaller companies.
Okay, to really get our heads around this, let's look at how these dynamics played out in other tech sectors. What can we learn from those comparisons?
Okay, well, take ride-sharing. Uber. That feels like a pretty clear winner-takes-all example, right? They raised that $13 billion plus pre-IPO. That let them scale incredibly fast, subsidize rides aggressively.
Undercut everyone else.
Basically, yeah. They thinned the field dramatically, leaving essentially a duopoly with Lyft. It really shows how massive funding in a market with strong network effects and big capital needs, like generative AI, with its compute costs, can lead to near monopoly.
But then you mentioned cloud computing and data platforms. That seems different.
It does. That looks much more like a rising tide lifts all boats situation. You had giants like Snowflake and Databricks raise enormous amounts. Databricks got $10 billion late 2024 at a huge valuation.
62 billion, was it?
Something like that, yeah. But despite those giants, the ecosystem supported lots of other winners, tons of adjacent startups. And remember, Google and Amazon backed Anthropic with billions after OpenAI was already dominant. That shows big players funding multiple horses. So the enterprise data and AI market was diverse enough, it seems, to support many players building on the core infrastructure.
And SoftBank, you mentioned them as a cautionary tale. How do they fit?
Yeah, SoftBank is interesting because it kind of straddles both. On one hand, they definitely accelerated innovation in certain sectors by injecting massive capital. But on the other, it led to that extreme valuation inflation, the flameouts, like WeWork. And it definitely distorted the playing field. It showed how giving seemingly unlimited capital to a select few makes it incredibly tough for traditional startups to compete. If x.AI and OpenAI operate like that,
It changes the rules of the game.
completely. They could do things like aggressive pricing or talent grabs that others just can't afford.
And then there's the Amazon effect in e-commerce.
Right. Amazon's dominance, fueled by the public markets, essentially squeezed out a whole generation of general e-commerce startups. VC funding just dried up for those types of companies until new models, like Shopify, emerged, building on the existing infrastructure, essentially. So you have to wonder, will OpenAI, x.AI, maybe a couple of others, become the Amazon of AI, dominating the foundational layer so much that the only viable startups are those building specific applications on top of them, or serving really niche markets?
Okay, so putting this all together, what does it mean for businesses like yours listening right now? The real world shows this complex spectrum, right? Surge and concentration happening at the same time in AI.
Exactly. And this isn't just for VCs and founders to worry about. It directly impacts you, the executive adopting generative AI. You're the customer, the user, the strategist here.
Okay, let's break down the impacts. What are the positives if we do get that broad surge?
Well, if the tide lifts all boats, you can expect more innovation, more solution diversity. More startups mean more tailored AI tools for specific industries, healthcare, finance, design, you name it. That competition should also lead to better pricing for enterprises. We saw that with cloud, right?
Yeah.
AWS versus Azure versus GCP drove costs down.
Sure.
Ample funding also means faster R&D. So quicker improvements in models, better features, maybe better security tools. You'd also see a richer ecosystem develop more integrators, consultants, open source contributions, a bigger talent pool, and potentially a broader global reach, with AI innovation hubs popping up everywhere, tailoring solutions locally.
Okay, sounds good. But what if we lean more towards that funding squeeze scenario? What are the risks for businesses trying to use AI?
The big risk is less vendor diversity, ending up with just a handful of dominant suppliers. If critical AI capabilities are controlled by an oligopoly, you risk vendor lock-in, higher prices, and maybe less attention to your specific needs. Think operating systems or office software.
Right, the usual suspects.
Exactly. That naturally leads to potentially higher costs and maybe slower innovation if there's less competitive pressure. It could also mean fewer specialized solutions. The major platforms might not prioritize niche sectors, say agriculture or scientific research, leaving gaps for some enterprises. And maybe the biggest risk, over-reliance, and systemic risk.
Yeah.
If everyone depends on just 2 or 3 providers, what happens if one has a major outage or a security breach?
Yeah, that's a huge vulnerability.
Diversification is the buffer against that, but a squeeze reduces your options.
That's a really key strategic point. How might these impacts differ depending on the type of business?
Well, small to mid-sized enterprises, SMEs, they probably benefit most from a surge. They get affordable, easy-to-use tools, but they'd likely struggle in a squeeze, as the big providers tend to focus on the Fortune 500s. Large enterprises, they're generally more resilient, they benefit from choice in a surge, maybe even invest themselves. In a squeeze, they can negotiate better because of their size, but still face higher costs and maybe slower innovation. Though some, like a Bloomberg perhaps, can just build their own internal solutions. Sector matters too. Tech companies can often build their own or partner deeply. Traditional industries often rely more on those industry-specific startups, so they'd suffer if funding concentrates horizontally. And emerging markets, they benefit from a diverse global spread. They'd lag if innovation gets too concentrated elsewhere. But what's really fascinating, and probably most likely, is a mixed scenario. Generative AI will definitely keep attracting massive capital, but yeah, a lot of it will probably keep going to the top-tier companies. So the sector expands overall, but unevenly. Concentration at the core, the foundational models, but maybe more diversity at the edges for specialized applications.
Okay, so that means preparing for different potential futures is key. Let's walk through those scenarios for you, the executive listening, the optimistic, realistic, and skeptical views.
Right. So the optimistic scenario. Rising tide lifts all boats. Here, investment surges broadly. You get multiple strong winners. OpenAI, x.AI, Anthropic, all pushing boundaries. This benefits everyone. Startups thrive, enterprises get lots of choices, can negotiate good deals, maybe influence product roadmaps. You get a collaborative ecosystem, maybe global democratization of AI. So, recommendations for you. Experiment and adopt early. Definitely diversify your vendors. Engage in partnerships, maybe through corporate venture arms. Leverage the competition for better costs. And just stay informed constantly.
Okay, that's the sunny outlook. What about the more middle ground, realistic view?
The realistic scenario is probably a mixed outcomes, a segmented landscape. So concentration at the core foundational models dominated by x.AI, OpenAI, etc. But you still get healthy diversity at the edges, with spare-life startups building on top of those platforms. Investor money splits. Late stage goes to the core, early stage to the application layer startups. For enterprises, this means you'll have a few core AI platforms to choose from, plus a vibrant marketplace of smaller, specialized vendors. Your strategy here: choose your core AI platforms. Wisely think about data privacy, integration. Embrace the ecosystem of specialized vendors. Watch for consolidation in M&A. Negotiate your contracts for flexibility. Build internal competence. And stay plugged into industry groups.
And then the more cautious or skeptical scenario.
That's the skeptical scenario. Funding squeeze and AI oligopoly. Here, x.AI, OpenAI, maybe 1 or 2 others really dominate. They control the advanced AI, the distribution. This leads to a funding drought for new startups. Innovation slows, focuses mostly on monetization by the big players raising prices, bundling things. Enterprises face high prices, serious lock-in, lose bargaining power. Innovation mostly happens inside the big firms. You might see more regulatory scrutiny too. If this happens, you need to strengthen your negotiation position, maybe band together with others, leverage your scale. Explore open source and internal development seriously. Prioritize flexibility in contracts, things like self-hosting, data access. Monitor and engage in policy regulation. Have robust risk management contingency plans for outages, price hikes, and really focus on talent development internally.
Okay, so let's boil this down. Bringing it all together, what are the absolute key takeaways for you, the business executive, trying to make sense of all this?
First takeaway. Generative AI investment is booming, yes, but it's happening unevenly. Record funding, sure, but a huge chunk is going to it's a handful of players. So for you, expect AI to be central to your tech strategy, absolutely. But understand your vendor choices, especially for foundational models, might become quite concentrated.
Okay, second point.
Second, that halo effect versus crowding out dynamic. It's real, and it's happening right now. We see evidence for both big rounds create buzz, but winner-takes-all forces are also strong. Your action. Experiment with AI solutions, definitely. But rigorously vet the stability of your vendors. Do they have staying power, a defensible niche?
Got it. Third key takeaway.
Third, the enterprise AI landscape could narrow significantly. If only a few companies dominate, you might face higher costs, less choice, more vendor lock-in. Your takeaway here: avoid over-reliance on any single AI provider. Keep alternatives open source, maybe building some capabilities in-house in your back pocket. Maintain strategic flexibility.
Right, but there's also a potential upside from competition, isn't there? Fourth point.
Yes. Fourth, there are undeniable competitive benefits for you if healthy competition does persist. These mega deals fuel rapid R&D. Multiple well-funded competitors vying for your business means more value, better features, better terms, potentially. Your move. Actively use this.
Huh.
Encourage competitive bids. Let vendors know you're considering others. That often gets you better deals or more customized solutions.
Makes sense. And the final takeaway.
Finally, number 5. Strategic planning for all these scenarios is crucial. Your approach needs to adapt whether you're operating in a thriving, diverse ecosystem, a mixed market, or a heavily consolidated one. So, tap into innovation broadly if the ecosystem is thriving. Align strategically with a core platform if the market is segmented. And double down on vendor management, cost control, and risk mitigation if the market consolidates.
Ultimately, the core message seems to be engage fully with generative AI now, embrace its power, but do it with a really strategic eye on how the industry's power structure is evolving. This isn't just tech changing, it's the market itself reordering.
Exactly. And this brings up, I think, a really important closing thought for every executive listening. In a world where these AI capabilities are becoming so central to every single business, what untapped niche, what truly unique application can you identify and champion within your own organization? Regardless of who ends up dominating that foundational layer, finding that edge could be key.
That's a deep thought to leave you with and something truly worth exploring. Thank you for joining the podcast and see you soon.